Hello, everyone. Thank you for joining us today. On behalf of 567 Workshops, I would like to present your guest speaker today, Ken New, here to speak with you on estate planning.
Hello, everyone. I'm sure some of you know at least one of these two people on the screen, probably the fellow on the right. Now, you probably don't know the guy on the left. So he's famous for delivering this message. What wisdom would you try to impart in the world if you knew it were your last chance? So his name is Randy Pausch. So Randy is a husband, a computer scientist at Carnegie Mellon University, a father, but he was diagnosed with pancreatic cancer. So he was tasked with giving a last lecture, one in a series of lectures that professors do when they imagine what they would say in their last lesson. And so most people don't deliver this type of message under such pressing circumstances. And it was recorded. His students listened to it. It was recorded. It went to YouTube sensation. He was on Oprah, Good Morning America. Things really took off from there for Randy. So what ended up happening then for him is that his story began to be very remarkable. It really kind of showed a great human resilience in the face of a personal tragedy. And you can see some of the notes from his last lecture. Key question to ask: are you spending time on the right things? Be prepared. And also, to be cliche, death is a part of life and it's going to happen to everyone. So again, that's Randy Pausch's story. He actually died in 2008, and he died in July that year. His family was around him. You know, he knew that prior to his death that it was going to be very difficult for them, but he really had an opportunity to put things in order. And if he could ever say that someone would have a good death, I guess it was Randy Pausch in this scenario. Now, in stark contrast, really, to Randy's story is the story of this person. And he's James Gandolfini. And you may remember the last scene of The Sopranos. He was the producer, the actor, star in Tony Soprano. He died unexpectedly in a trip to Italy at age 51. Only left 20% of his estate to his wife, a $30 million tax hit on a $70 million estate. So unfortunately, things didn't go well for James Gandolfini. And so that story was played out, I guess, generally also in the real life, as well as The Sopranos. You may remember the last scene of The Sopranos. The story kind of goes like this. He was having dinner, and what was happening is that they were waiting at the table, his son AJ and his wife. They were waiting at the table for Meadow to show up. She was parking her car. The camera kind of goes from the parking lot back to the scene. And what's going to happen? Is it going to be Meadow coming through the door? Is it going to be the mafia hitman coming through the door? And the end result is that the screen just goes blank. And so just like in the hit movie and the hit series, The Sopranos, what happened is that there was no resolution to it. There was no deathbed scene. There was no final goodbyes or anything else like that. And so in real life, James Gandolfini's scenario played out very much like it did with The Sopranos. And so I hope you can kind of see the parallels between the two here. Randy Pausch had time, and he took time to set his things in order. James Gandolfini did not. And so we explore some of those differences as we go through the presentation today. All right, so let me take a moment and introduce myself. I think that it is unique for a financial planner to be talking about estate planning. One of the reasons why I do it is that, you know, in the world today, I think there's a lot of things that are part of the estate plan that have to do with the financial matters. And far too many times I see that folks are getting into the estate planning arena and thinking about what they're doing in estate planning without taking into account all the different aspects of what it takes to pass money on to the next generation, or even their ideas and their thoughts in family matters and so on. So I'm going to take you through this journey of financial planning in estate planning. We will be talking a bit about tax strategies. We'll talk a little bit about the Jobs and Tax Cut Act and how it affects financial planning in estate planning. We'll also talk about the Secure Act and how it affects the financial matters of estate planning. I'd like to also prompt some of your thoughts in thinking about the qualified money. Very often in estate planning today, we're seeing lots of equity in a home, and we're seeing lots of deferred money, tax deferred money. And so how does that play out when we're leaving it to beneficiaries under the new Secure Act? So we'll talk about that. I'll give some examples as we go along. And then, of course, also talk about some of the new tax laws that are being proposed, the 1031 exchange or capital gains taxes and things of that nature. See how that might play out in your future. So there you have it. Let's move into kind of the nuts and bolts of what's going on in estate planning, make sure that we cover those kinds of bases. First of all, one of the challenges, of course, in estate planning is the use of the typical documents, the wills, the trusts. In many cases, they're not in place, and it would be very helpful to have those documents in place when we're thinking about how the money is going to pass to the next generation. So that's one main consideration. One of the issues I think with the whole idea of financial planning in estate planning is, do we have the basics done? Do we have the assets being named on the beneficiary pages correctly for the IRA accounts or 401ks or 403bs, 457 plans, TSPs, those kinds of things, with tax deferrals in place, and understanding how that asset would pass on to a spouse, and then maybe differently when it passes on to other beneficiaries, typically kids or grandkids, or how capital gains are being handled, whether the step up in basis is going to be relevant, and so on. So that has to do with naming beneficiaries in that scenario, in the scenario of just passing it on without the use of any formal estate planning documents. But very often, it's going to be relevant, depending on the individual circumstances, that we have a will or a trust possibly in place. And of course, trusts come in a couple of basic varieties. They're going to come in either a revocable trust or an irrevocable trust. So I have an opportunity really to kind of feed that into the presentation today. Here, we're just, again, reinforcing the idea of having this first phase taken care of do we have a document in place that takes care of the basic kinds of estate planning that we think is relevant for our estate plan. Now, one of the other things I think that is happening also that can be of shock to an estate planner and to the beneficiaries and such is this capacity, this sudden incapacity where planning isn't in place. What's interesting here is that capacity can happen at any age. It can happen at younger ages and older ages. Older ages, many times we may suffer a stroke. All right, so there we're not in a place to be able to make decisions for ourselves, whether it has to do with a financial matter or a healthcare matter. And so there is the capacity issue in the older ages. Younger ages might be an accident. It could be a car accident, slip and fall, bang our head. We don't know what day of the week it is. So then in that scenario, again, who has the ability to make financial decisions? Who has the ability to make medical decisions at that point? So again, capacity, the wills and trusts are an important element in an estate plan, and then having documents in place, healthcare surrogates and durable power of attorneys to be able to address those kinds of issues. All right, so again, I think one of the things that we have to rationalize is that there is an issue in estate planning. And one of those issues over the generations now, I've found that it causes us to think about dying. So the whole idea of estate planning brings up this idea that, well, I'm going to die one day. Well, we're all going to die one day. That's just natural. That's part of life. And so there's a perpetuation of this whole death denial. And in many cases, getting started is the key. Just getting some thoughts down and some ideas down, and especially when there are special circumstances in place. There could be special needs for beneficiaries. There could be a scenario where we've got a second marriage, or we've got other kinds of aspirations in our estate plan. So again, that type of scenario, I think, is exasperated. We put it off because, gosh, it's much easier not to deal with it than it is to deal with it and have to face that idea of our mortality. All right, so here again, with no estate plan, what kind of problems are there? Well, first of all, there's this idea of probate. Now, many times we'll talk about probate and we'll say, well, probate's is something we want to avoid. And in some cases, it can be unavoidable because we just miss some assets. But in most cases, the benefits of avoiding probate mean that you're in a more controlled position, meaning that probate is very public. Okay, so it has to be, broadcast to the community that there's a death. The second thing is that it takes time, and it sometimes can take a significant amount of time, and there's cost associated with it. So those are three basic pillars of kind of the motivation to avoid probate. Where it goes from there really is that, you're thinking about some of the issues is even within families, there can be disputes over a probated asset. Which then prolongs that whole legal process. And at the same time, then it creates more cost. But also, even if it's not within the family, which is hopefully avoidable, but other creditors, people come out of the woodwork, they can see that there's an estate that needs to be probated. So, therein lies the opportunity for some anyways. So there again, the idea there is to have that planning in place. So let's continue on with that. So some of the common problems, the planning problems, no will or trust, we've talked about that. But this guardianship issue, for the first time today, we've talked about it, and it can become real. There are clients of mine who have been grandparents for many, many years, and now they're already in a position where they may have a grandchild who they're taking care of. And so in which case then, if they were to die, who has the guardianship of those? And especially if there's a special needs scenario in place as well. So it puts us in a spot really where that guardianship becomes a debatable point, and how relevant it is depending on the capacity for that individual to inherit, or whether or not you want that individual to be able to inherit. Okay, but in addition to this is this idea of tax planning. And there's a lot of depth to this, but I'm going to again go back and talk about the Jobs and Tax Cut Act. That act itself created an opportunity in tax planning today. Why? Because it lowered taxes for the vast majority of folks. It lowered taxes to almost all-time highs. I think, the lowest taxes in a couple of generations at least. So a nice opportunity there, compounded by the Secure Act, which came right after it. And the Secure Act came in and said, well, we're going to let you pass your retirement plan assets on to your spouse, and they'll be able to take it just as if it were their own IRA or their own qualified plan. But when you pass that on now to your kids or grandkids, or some other entity outside the marital unit, then what we find is that could be then a taxable event. All right, now it's up to the custodians in many cases, but the law really says no longer than 10 years. So that's what the IRS code is going to dictate, is empty that account out in 10 years or so. Now, look, if it's a smaller IRA, smaller qualified plan, that's not such a big deal. If it's a bigger one, yes, and there's some planning in place. Thankfully, the attorneys have some solution for that, and we kind of coach that. So when we get together with an attorney and we're going through the idea of maybe developing a stretch IRA trust, and we used to be able to do a stretch IRA in the past, But what about a stretch IRA trust? Well, that's going to involve some elements of revocable and irrevocable trusts. Okay, outside the scope of our talk today, but it's something to investigate, especially with larger IRA accounts. Of course, also in some cases, you may think about the idea of would it be wise to convert to a Roth IRA? Again, outside the scope of our talk today, but is it in your best interest to look at those two factors to see whether or not they would benefit your estate plan? Right then, so there you have it. There's that piece on some of the common areas that we want to take a look at. From there, then, just continue on the basics here. What are the benefits? Well, they're pretty basic. Here we have 3 generations on the screen. The benefits really are being able to point out how you want to be taken care of, how the possessions, how those things, the tangible assets, can be passed on the next generation. So how do you avoid the costs? There are legal expenses, yes, but maybe on the front end more so than on the back end. It's kind of the whole idea of having that smaller expense up front to avoid larger expenses on the back end. And in some cases, you're going to have your loved ones, some of your family members, some person or some entity out there. It could be a charitable entity that you haven't provided for that you'd really like to. And so that's kind of the essence of what this screen is all about. So what's really missing at this point, however, is this idea of intangible assets. And so I want to insert this here just to talk about a well-rounded estate plan. Not only provides for the tangible assets, the money, the things that we have, and that can be real estate, like the big things, the real estate, the business entity. It could also be things like the retirement plan assets and money in the bank. Okay, so those are big things. And but the flip side then is, what about the other kinds of things? So the family legacies, your heritage, spirituality, those kinds of communications, I think, can be helpful as well to the next generations, especially when we're thinking about our grandkids. Sometimes that next generation beyond our kids, looks back and sees, where did grandma and grandpa come from, and where did they do, and what's important. So again, this can be as well documented and passed on, and there can be great value in that, emotional and kind of a good feeling about doing that type of planning. So we emphasize that as well. Now, by definition, we're talking about generational planning. It's really kind of a two-phase process we'll talk about here. I think generational planning is a way to be thinking about this type of estate planning, but it really gets down to the nuts and bolts of estate planning. The first objective really is how we're passing the assets on to the next generation, the tangible part of it. And then the second really is conveying really the family values, the legacy, what were we all about? What are our values and thoughts and things like that? So, really moving on here, then the successful legacy plan, I think, really takes care of the spouse kind of first and foremost, but it really depends on what your financial plan is all about, especially when we have second marriages or third marriages and so on. But again, the spousal unit is protecting a lot of the qualified plan assets, because then it creates a tax strategy there that may or may not be in your best interest. But at the very least, for most of us, we're looking to leave enough money behind to take care of the expenses, to take care of the day-to-day. We're living a lot longer today. We're getting into retirement in many ways. We're going 10, 20, 30 years and beyond that. So a significant number of us really would benefit from just having that basic plan in place for our spouse and make sure that we've covered that very, very well. As a side note, I will tell you that the baby boomer generation, when we're fully retired, will represent a larger group of retirees than the accumulated amount of people that have retired in the history of our country. So that's very profound to look at that data to say all the people that retired before baby boomers are less than just the baby boomer generation, and we're living a lot longer. So therefore, financial planning inside of estate planning and coordinating these two become really key. Beyond the spouse, then we'll talk about the children. Are they prepared for an inheritance? Do they know what to do with these assets? Now, look, for many of us, we've toiled long and hard and saved and sacrificed. And that puts us in a position to where these assets are meaningful to us because there's, blood, sweat, and tears, so to speak, that have put this pile of money together. And if that's the case, then are we prepared really? Are the kids and the grandkids, are they prepared? Do they understand how this is all going to work out? And therein lies that key element of bridging that understanding of the asset and how it would work. And, it's not necessarily just saying, okay, well, this asset provides income or this asset is meaningful in certain kinds of ways. We kind of go back to the Secure Act and saying that it's going to draw down in 10 years. Hey, statistically, they will tell us that when a beneficiary inherits, especially even larger sums of money, they almost ignore tax problems and they take the money in a short period of time, maybe in a lump sum, regardless of the tax hit, or maybe quicker than the 10 years. And that just represents an opportunity to have saved the tax hit and made it more beneficial to that beneficiary, right? So again, there can be some sideboards that are put on, some constraints that are put on that with special needs trusts in some cases, in stretch IRA trusts in some cases, and just taking a look at how it is that we might be able to make that happen. So that's part of the tangible assets. And then, of course, there may be some charities, some things that you are near and dear to and would like to be able to provide for. So there you have that. So really, what I'll introduce here is kind of this six-step planning process. It really just kind of moves through the whole idea of the entirety of a financial plan. The first of which, is quick recap, is going to be the incapacity. Okay, so key. This is real life stuff. It happens. I've had it happen to my clients. It's real. Okay, two important things that are necessary here. And these are things that if they're not done, they need to be done yesterday. Okay, advance directive for healthcare. Who would make a decision for you in a healthcare scenario? But the other is power of attorney for finances. Let me paint a quick picture for you. If there's not access to your bank account to pay your bills, who's going to pay your bills? Have you been able to put that in place? That's part of the capacity. So it'll be important to recognize that as a piece there. Now, part two really is to get organized. And that's just as simple as it sounds. It's just, where is the stuff? Where is the information about the stuff, right? And so that can be fairly straightforward, I think. The property that you own, how you want it divvied up, just simple kinds of subnotes, if you will, to savings accounts, investment accounts, retirement accounts, real estate, business interests, even jewelry, artwork, everything that you have. Some kind of conduit that helps to understand that. But don't forget some of the other basic things about it. I mean, if it's loaded on your computer, as an example, many of us have gone digital, so that information is there and it's not actually on a piece of paper, or it might be both. But do they have access to the computer? Is it locked out? Passwords are key. What do you want done with social media accounts and such like that? Okay, so these are things to be thinking about that can be helpful in the organization of a financial plan. Now, as we continue on, then part three really is that you think about all the people and the causes. So now we've organized all these financial matters, and now where would it go? In what percentages or what dollar amounts, and how would it go? Are we utilizing the right kinds of assets to do that? In some cases, we may want to pass on qualified money because we can not have to pay taxes on that, benefit the charity, and get some benefits out of that. So charitable remainder trust as an example. So there's different kinds of vehicles that can be used for different kinds of circumstances. Again, the key here is to have a solid estate plan, but then it also has the elements of a financial plan that really have the capacity to be able to take care of the tax hits that are inevitable to it. I mean, look, taxes are going up. I think we all agree on that generally. We just don't know how it's going to affect us. And we're seeing some of that at this point. We're seeing the new proposals, this $1.2 trillion infrastructure bill, the additional $3 trillion in additional printed money, and probably the whole expectation that will continue on with quantitative easing, then very low interest rates, and these kinds of elements. It suggests that the money's got to come from somewhere. It's going to come through, the basics of taxation, especially looks like the playbook looks to take some of the money out of the estate when it goes to the generation past spouses. Okay, so there's a lot of fodder to look at that. So how can we be more efficient there? And so there you have an idea of how the tax planning is so key to the net effect and the result of a financial plan. All right, so let's continue on, maybe a couple special circumstances, and I chose to dive into that really at this point here. So what if the spouse does die first? That has special considerations for all the obvious reasons that I've just talked about. Passing money on to the next generation can be a little bit challenging and so on. But let me just give you just an idea, something to think about. It's been used and people like this idea. So when we're thinking about a scenario, and I'll give you this thought: single spouse is left behind, and the home's paid off. Okay, so they own free and clear their personal residence. They have one child, one son, I'll say here. And so the idea is that, well, I want to leave the son my home. All right, well, upon death, there could be a ladybird deed in place. And so I kind of name drop that type of trust, that type of estate planning document, because that's an efficient way to pass on a personal residence in this scenario. And so we have attorneys that advise you on that. That's not my forte, but that's a vehicle that can be used. But I'll take it one step further. Let's say that in this scenario, that the home was worth $250,000. There's $250,000 of equity in it. That's what is planned to leave behind to the son. Now, what if mom, in this case, were to sell her home to her son? Okay, now $250,000 of equity, of gain, if you will, of a personal residence as a single taxpayer would not be taxed. Okay, so she can sell that. And what would happen is that she would realize $250,000. So let's take that money and put it in the bank at this point. All right, so there is that money. Now, the son owns the home and he's going to make the payments on it. Well, we happen to be in a low interest rate environment. So there's kind of some opening there that might be an okay thing for son, because now what happens with the $250,000 that was equity in the home going to the son is that now mom takes the $250,000 and she buys a life insurance policy. That life insurance policy would be guaranteed. Okay, life insurance policies have reserves. Okay, they represent really a promise to that beneficiary. Now, what happens is that money would provide a death benefit. So $250,000 in this scenario would be somewhere between $400,000 to $1 million in tax-free death benefit that would pass on to the son. So again, not for everyone, but if you really wanted to lever up an estate and how to pass it on to the next generation, to the son, there's an idea for you to be thinking about. Okay, so just a little bit of again, not the advice, just a kind of a way to be thinking about estate planning in a different way other than here's the asset, do with it as you please. If you're going to leave that asset, this might be a far richer way to do that. All right, so, again, going off on some of these special circumstances to give you some sense about what it is that you can do here. Okay, again, repeating a couple things here, divided equally among children. Again, this is a nice way to be able to be thinking about, okay, who gets what and how much. They're capable of handling it. And again, I make note of the special needs. Okay, that's a whole nother scenario where you don't want to interrupt special kinds of income streams that would go to special needs children by having them inherit large sums. So there's tactics that are in place that the attorneys can help us with in that regard. All right, so kind of getting in a little bit more on the nuts and bolts on the tangible kinds of assets. So here's the whole thing, is the traditional part of estate planning, we're making these kinds of decisions, and it's important to put that information in writing. It's just, the key here is that we want that information to be such that everyone knows what it is that we're doing. But really, to continue on, let's just talk generally about some very simple ways to do that, or some in very intuitive ways. The assets that can be transferred through titling and beneficiaries. All right, so what this really means is that I like to focus on the qualified plans as well as any named beneficiary account. It could be a TOD account, it could be a life insurance policy, it could be an annuity contract. These kinds of titling is key. When you create the account, in most all cases, as long as all the parties that are helping you are competent, you're going to have named beneficiaries. Now, here again, they may have changed over time, but you're going to have named beneficiaries. Those assets are going to go to those beneficiaries without probate, okay? So without being encumbered. They're going to be very efficient in most all cases, all right? So that, again, is in the titling. So you don't need a will to do that. You just don't, okay? They'll just be coordinated, all be taken care of. And so there you have that. Now, what will happen, though, is there may be assets that are not named because of the titling and the account structure. Having said that, then that's where a will is very necessary. Even with trust work in place, revocable versus irrevocable trust, even when that is in place, what happens is that we would want to have what is known as a pour-over will, or a will that accounts for things that weren't being accounted for ahead of time because they may have just shown up in the estate and we hadn't had time to put it in the estate, or any of those kinds of things. So that's a helpful reminder on just the basic titling and accounts, especially with the structure of the account and the way that you have set it up. Now, here we venture back into the family legacy. This can be fun. This can be a lot of fun, in terms of just getting into some of the elements of the which is unique to everyone. And what I mean by that is that it could just be, thoughts. It could be thoughts about previous experiences, and so it could be a diary. It could be a journal. It could be something like that. It could be scrapbook and photos and so on. For some, it can be recipes, special skills. The whole idea of it is endless. It's you. It's your values and such like that. So again, that can be some fun. That can be interesting to be able to put that together. But really, in the final phase, the sixth phase here is that it's the monitoring and updating phase. This is where, as time goes on, something's going to change. We might have, a marriage. We might have a marriage within the estate. We might have a marriage that happens to beneficiaries and such like that, or someone has gotten divorced or died. So it'd be important then to understand that. And even when we have assets where we've named beneficiaries, and we know those assets want to go to those beneficiaries, are they going to go to the beneficiary, or are they going to be passed on per stirpes? So again, the attorneys talk about, the whole idea of, do you want it to go through the bloodline? So if son or daughter were to pass, would it go to the spouse, or would it go to grandkids? And that starts to be addressed through this per stirpes concept that we're talking about. Again, outside the scope of our talk today, but it's something to bring up in that coordinated conversation with an attorney. And I've always said that what's so valuable in a good estate plan is that we've taken the time to talk to our financial advisors and being able to hash through these kinds of elements. Now, within my practice, it's real important that we advise on taxes as well as financial matters because they're so key, they're so encumbered together. But once we get that straight, then we're very, very methodical when we get to the attorney, because then it's like, here's what we want to have happen. You draw the legal documents that will make that happen. And then the pros and cons of that from the legal structure side. Okay, so that way you've really got a good strategy in place and make sure that the wrong people don't inherit assets. All right, so where we go from here is just invite us really at this point to work together to go through this whole process. I mean, that's why I did the Randy Pausch, James Gandolfini conversation to begin with, because I thought it was really a very much a contrast between the two. Here were two completely different individuals. Randy Pausch, not wealthy person, but really when he left this earth, he left it in a very organized, systematic way. James Gandolfini obviously was worth a whole lot more money and just hadn't got around to. It wasn't really a matter of the amount of money that you have in estate planning. It's a matter of taking the time, the effort to make that all happen. So again, I think that's well served when you work with a professional, when you work with someone who is organized, been down this path several times. Here I just kind of show a quick little hit of kind of a 4-week start to finish. Get a healthcare surrogate. You know, look, the durable power of attorney in healthcare really can be done all in one snap. As a matter of fact, really a lot of these documents can be done together in a sitting with an attorney, as long as you've got the pre-planning phases all taken care of and sorted out and so on. But I bring this up really because I think it's helpful to look at just a systematic kind of strategy to move forward with this. Okay, so again, financial planning and tax planning really kind of go hand in hand. And if the same person, the financial person, is not the same person on the tax side, then they should be talking to each other and coordinating what they're doing. That's really a key. It goes back to really the whole retirement planning idea of, do I have a retirement plan in place that is effective or as effective as it can be? And if not, can someone explain that to me, right? So that's coordinated so that the tax advisor and the estate planning, financial estate planning side are taken care of. Then we refer to an estate planning attorney. Now, certain attorneys for complicated matters, we're talking about irrevocable trust. We might have an irrevocable life insurance trust, which could be to your benefit. Where we're levering an estate. There could be a little more complications, a wealth management trust, irrevocable. So that takes specialties there. Basic trust work can be handled by many attorneys, but wills and healthcare surrogates, durable powers attorney, are all handled by attorneys. So what we're doing is we're trying to match up the attorney with what the financial expectation is, what the estate planning expectation is. So we can refer and get you involved with attorneys that have those kinds of specialties that are going to address your needs. One of the other things I think that are, is key at this point is really just the idea of, when you work with someone such as myself or others, that you're working with someone who has the ability to be able to keep in touch with maybe new tax laws, with maybe new estate planning laws. I mean, this is an ever-changing environment that we've got going on. I mentioned earlier, the Jobs and Tax Cut Act affords us really some of the lowest taxes that we've seen in a couple of generations. Well, that's great, but when will that change? We know that it's designed to sunset in 2025. So we know we've got that window ahead of us. And if it stays in place till then, which, it's surviving so far, that could be a good thing. And so it could give us a window of planning opportunity there. So again, working with a professional, you're able to get frequent financial checkups and really just kind of move the whole process along. All right, then, from there, really, I welcome the opportunity for us to have a chat together, and there is no obligation to it. There's nothing inferred. There's nothing. This conversation isn't a sales pitch in any way, just like the private consultation is not going to be a sales pitch in any way. There's really nothing to sell. The whole idea at this point really is to take a look at what the options are and see whether or not there's a way that we would have a fit to be able to work together. So I invite that opportunity. I look forward to that opportunity. We can do that virtually. We can do that in a phone call. We can do it in a Zoom call like this. We can do it in the office. We have a very clean office. We are followed all the mandates for being able to do face-to-face kinds of conversations. So there again, those are the options available there, and I look forward to that opportunity and invite that. And from there, then really kind of moving on here, just the whole bottom line is just what's going to feel like when you kind of move this whole process along, and you put yourself in a position to where you know what's happening, you feel comfortable about what you've done, and it just you're all set. And so we'll kind of get to the conclusion here. Again, is your legacy all set? Do you have a trusted person ready to step in to take care of things? Are your records organized? Are your loved ones provided for? And, all the things that really would make you feel comfortable so you can continue on in retirement life and continue on with your life such that, you've done the right thing for all these years. Now you've done the right thing on your way out. So again, I don't think that legacy planning is hard. It's just a matter of getting started with it and seeing where it goes from there. So that's really where our formal presentation closes. I look forward to the opportunity to speak with you or talk with you via Zoom, or also the opportunity to meet with you face-to-face. Again, there is no obligation to that. We'll reach out to you or reach out to us, and I look forward to that conversation. Thank you very much.